for too few deals. Where do VCs go from here? Leading us will be Ron Suber. Joining him will be Charles Birnbaum of Bessemer Venture Partners, Brian Hirsch of Tribeca Venture Partners, Rebecca Lynn of Canvas, Maria Gotsch of the Partnership Fund for New York City. While we fix and troubleshoot Ron's issues, I think we'll go around the room and just do some quick introductions. We'll start with you, Charles. If you could just tell the audience a little bit about yourself.
Well, thanks for having me today. Quite a few LendIt conferences for me. Miss being in person and seeing everyone in the halls, but this will have to do this year. I'm a partner here in our New York office for Bessemer Venture Partners, where I help lead our global fintech practice. I've been with the firm for about 8 years and work with all of our portfolio companies across lending, payments, wealth management, bank software, developer platform, economy companies, and excited to be here today.
All right, Maria, we'll go to you next.
Hi, everybody. Great to be here. I look forward to next year in person. So I run I'm the president and CEO of the Partnership Fund for New York City, which is backed by the large corporations of New York City, many of the big banks. But we are structured as a nonprofit, mission-driven fund to create jobs in New York. So we invest both in low-income neighborhoods and also in growing sectors in New York. So we look and think about the underserved when it comes to financial services, as well as the traditional fintech area. We run, in particular, the Fintech Innovation Lab, which is a graduate school accelerator program to connect emerging technology companies to large financial institutions. And look forward to the conversation.
All right, Rebecca, we'll go to you next.
So Rebecca Lynn, founder and partner at Canvas Ventures. We are an early stage venture fund, so we do Series C through Series B, and we focus very heavily on the fintech space, and our really core strategy is helping people scale their go-to-market. So I've been in financial services for 20 years, starting at the first online credit card company. And then most recently, we're investing very heavily in sort of retooling the banking infrastructure. And one example of that is a company, an investment we led in the company called Brace in the mortgage servicing area.
All right. And Brian, over to you.
Great. Thanks for having me. Brian Hirsch, Rebbeca Venture Partner, one of the two co-founders and managing partners at the firm. We started Tribeca Venture Partners about 10 years ago. To invest early stage, primarily in the New York ecosystem. We're a broad-based generalist firm that invests in pretty much every sector. Having said that, I've done a fair amount in fintech over the years. I've been in venture for now coming on 23 years and started my venture career within the venture arm of ABN AMRO Bank in 97. So I've been looking at technology companies focused on financial services for over 2 decades.
All right, and Ron, do we have you back?
Yes. Hey, Todd. Hello, everybody. Sorry about that.
That's okay. Take it away, Ron. We did intros.
Fabulous. Thank you, everyone. We have 35 minutes with 4 great venture capitalists. I've had the chance to speak with this group and the audience to come up with 6 questions that everybody really wants to hear. We're going to go in alphabetical order by company. So Bessemer first, then Canvas, then Partnership Fund, then Tribeca. Let's get right into it. We all know that investing in private companies and being venture capitalist, it's easy to get in and hard to get out. So let's start with the first question, the entrepreneur and the venture capitalist dream, the exit, the monetization, and getting liquid, whether it's public, SPAC, direct listing, or an incumbent buying. Charles, take us first through the exit and what people should think about when taking money from VCs and the dream of getting liquid.
That's a good question. You know, I think it's really personal for most entrepreneurs, and I think you want to align yourself with venture capitalists that are really along for the journey with you in a way that that you're aligned from day one, and that there's transparency at every turn, because things change, things evolve. Personally, I'll use an example from the lending space. We sold a business called Bread to Alliance Data Systems late last year in the unsecured lending space. And we had still a lot of high hopes for the business and potential, but it was a phenomenal outcome for the team and for our LPs. And we did end up selling the business, even though we had alternatives. So, I think it's important to be aligned with investors that can react to the realities of a market. And from day one, you want people who are patient, but not everybody is going to agree when it's time to exit a business, and it's a complicated set of decisions.
Agreed. Rebecca, what are your thoughts on the exit?
Yeah, no, I agree with what Charles said. And I think for me, what I really emphasize with founders is optionality. So from the very beginning, talk with people who could be potential strategic partners, because those could also be investors or acquirers in this sense. I mean, that worked with Future Advisor, which was acquired, by BlackRock a few years ago. And so from the very beginning, just, it's forming those relationships and those opportunities where at any point in time you have optionality between raising money, a strategic investment, or maybe even an exit of some sort. So that's always what we try to work on with our founders and help them form those relationships.
Maria, what are your thoughts here?
So there's an interesting phenomenon in venture, which is that there's a moment when it is all about the promise of the company because you're early and it's an interesting idea, it's an interesting innovation, you start to get some early traction, but you haven't been around enough to show sort of what an actual growth would look like. And there can be sometimes a very interesting outcome that happens at that point because you're selling a dream as opposed to the reality. And so if an offer comes in, and to my other panelist's point, and everybody's aligned, sometimes there can be, not necessarily big dollars, but a big return that happens at that early point of you're being sold around the prospects as opposed to reality. And then after that, I think then you have to sort of take into account the risk. If you get a nice price at that point, there's a risk factor that you don't execute and actually get to the dream that you've been talking about. So there's a point at which it sometimes makes sense to sell early. But then after that, I think, the other panelists, made very good points about, where are you in the cycle? Do you have a repeatable product? And can you scale the business better with the partner that's going to acquire you than on your own?
And Brian, what are your thoughts here?
Yeah, I think what I would add to that, I agree with everything that's been said. But what I'd add to that is, we start before we make the investment, talking with the founders about exit. And the reason is that not that we're focused on exit, that's usually many years out, but really to make sure we have alignment with those founders to say, okay, what are your goals for this company? Do they align with what we're looking to do as a fund? And then each step through there, we tend to be a Series A lead investor in most of our investments, but each round from there, we try to attract investors are also aligned with how we view the opportunity and the founders, so that there's alignment, hopefully, going in on that vision. And then the second thing I would add is just to kind of really reiterate what Rebecca said, which I agree with more, is we also start talking to founders very early on about, okay, well, who would be the acquirer of this business, even if you think you want to go public. And we encourage all of our companies to think about to be strong, independent businesses that have options. You want to start those relationships very early. It's a dating game, and it's much easier to get a premium exit in the market when that team that's acquiring you, the people business, people are people at the end of the day, can draw a line and see the progress over time, have gotten to know the founder, team, know what the DNA of the company is a little bit better than they would just from, hey, we hired a banker, we've got a book, we're going to go sell the business. That can work, but in my experience in venture-backed companies, companies are bought, not sold, at least the great exits. And so we encourage our teams to really lean in and get to build those relationships early and often.
That's helpful, everyone. Thank you. There's an old saying from South Africa, in like a banana, out like a pineapple. It's easy to get in these deals, but really hard and complicated and painful to get out. So think about the pineapple also. Brian, we're going to stay with you and go in reverse order. So Brian, Maria, Rebecca, then Charles here. On the other side of the coin, the nightmare, the down round, dilution, impact. Talk to us about how each of you think about a down round, and how should these entrepreneurs work with you, the venture capitalists, during this tough period? Brian?
Yeah, well, we could do a whole panel just on this topic. It's funny talking about down rounds in the market that we're in because sure there are down rounds going on. I haven't seen any in quite a while, but I can guarantee there will be some in the future. That's the way it is in the markets. They have ups and downs, and so I think this. Before talking about how to deal with the down round, I think one thing I'd want to talk about is the ease at which entrepreneurs are raising capital right now. I think there's never been a greater time to raise capital as an entrepreneur. Maybe 1999, but definitely this is after that or close to it. And we're seeing a lot of what I call shotgun weddings in the market right now, where companies will meet with a venture firm and they have a term sheet within 24 to 48 hours. They're closing 2 to 3 weeks. And I just caution founders to think twice about that, because the average life of a marriage, the average length of a marriage in the United States is about 8 years, and that's about the same as the average length of an early stage venture investment. Venture investment might be longer, and so if you're the type of person that will have a shotgun wedding, meet somebody, and marry them within 2 days, then it's probably okay. But if you're not, you might want to rethink that, particularly since it's much easier to get a real divorce than you can't divorce your investor, you can divorce a spouse. And so in many ways, it's even more challenging. So I think that's the first part of it, because if you do a round fast and you get by the super high valuation because someone's trying to win the deal, you now are priced to perfection. And any mistakes or any changes to your plan and you need capital, you're risking a down round. And then once you get to that down round, I think it creates a lot of internal issues around employee motivation. We've seen in the past when you have down rounds, companies sort of bleed people, they lose momentum, they lose the sort of the buzz in the marketplace, which can impact customer adoption. And so, a word of caution in a very hot market to entrepreneurs to try to balance the hotness of the market with making sure you don't do something today that you're going to regret in 12 to 24 months. The multiples 7 years from now, when you're looking to exit, will not be the same multiples that we see today. They could be higher, but they very well, if you look at it at a historical level, are more likely to be lower.
Well said, Maria. How should these entrepreneurs listening to everyone today work with venture capitalists in the down round situation?
The number one piece of advice is you have to be realistic. So when you're heading into a down round, the fantasy is over. And so you're really in kind of the reality of the world. And the visual that I like to share with entrepreneurs is that of the crumbling cliff. Right. So a down round is basically, and usually it's the environment, something's happening in the environment. Sometimes it's specific to your company, but often it's the overall environment that things are shifting. And when that starts to happen, if you're going into a round, don't fall off the crumbling cliff. You need to run back faster than that cliff is crumbling. And that sometimes means a down round. And so it's really about understanding and making sure you're being realistic about the current environment. You need to over-communicate with your particular lead investor about what the situation is, what do you think the right options are, what are the valuation, and don't equivocate, don't hesitate. You got to make some decisions pretty quickly, particularly if you've had some conversations with some funders and they put some numbers on the table that are it's the down round, you don't like it. But if your sense is that the environment is moving against you, really you should take the money sooner rather than later at a lower valuation. But better to take the money than to have that cliff crumble and then you're left with no money. Forget even a down round.
Very well said, Maria. Rebecca, so the fantasy's over, as Maria said, in this situation. The insiders are at the table. It's a down round. How should these entrepreneurs work with you?
Yeah, really interesting. I actually entered venture after many years of operation in 2009, right? So if you remember what that fall of 2009 looked like, and so I was running triage on a lot of the companies that were with the current firm already. I also thought it was a great time to start a company, right? So there's no better time to start a new venture than when the market is falling apart. But the way that people should work with an investor with a down round situation or any difficult situation is quickly, rapidly, and with full transparency, because we're in the boat with the entrepreneur. And we need to, work as fast as we can as a team to right size things and correct the situation and set the company up for success going forward. And so the only way as an investor we can do that is if we understand very quickly what the full picture truly looks like. And in those situations, back in the past when these things happen, we've had some incredibly successful outcomes. But we really need that full transparency and almost a war room kind of planning situation to make sure that company is set up for success in the future.
I love the right sizing and transparency. That's very difficult for some of these first-time entrepreneurs. Charles, you've never had a down round. Do you want to talk about this or move to the next topic?
I have certainly had a couple. Been around a little bit longer than I look. The one nuance I'd add was everyone made great points. I think the one nuance I'd add is there's usually a partnership between the investors that step up in those down rounds and the team that is going to be going forward. And just like Rebecca just said, you get in a room, you figure it out. You want to incentivize those that are going to be there building the next phase of the company as if it's a net new investment and really getting on board and trying to capitalize the company properly, not just giving enough to bleed a slow death. So making sure everyone who is going to stick around steps up, gets compensated for that with significant ownership, and then also carving out enough for the leadership that's going to be sticking around and marching forward. It's painful for those who leave, both investors and former executives, but that's just the reality of it. So I think that's just one nuance to point out.
Great. So let's get to the third topic. Charles, we're going to stay with you and then go Rebecca, Maria, Brian next. This is the topic of debt versus equity. We're seeing lots of debt players come in the business, whether it's venture debt, mezz, warehouse lines, or other internal SPVs. Charles, talk to us about the tensions between the debt holders and the equity holders and the alignment between them at times also, please.
Yeah, this is another one where I think you want to think about upfront, working with your investors to understand which debt providers have been through different cycles, how they've acted in the past. There's a lot of net new players in this market that have come in over the last 10 years who haven't been through a lot of these things, so you can't do that diligence. I don't know how some of those folks are going to react. There are a few players that we've worked with for many, many years, long before I've been at the firm. And we work closely with them. We're honest with them about our level of support going forward. And they try and work with the company to be reasonable, when things aren't going well. But there's not much tension these days between those two parties. Mm-hmm. I think the debt providers are in a tough spot right now because equity capital is cheaper than it's ever been. There's a lot of new alternatives out there. I'm sure there's been panels on pipe and cap chase and all these new models that are popping up. So it's right now everybody's very friendly with one another. But I think when you do put on a debt facility onto your books, and so much of the audience here is putting in warehouse facilities and talking about advance rates ranging from everywhere from 70 to 100%. You got to really think about who you're working with long term. You might not want to take the cheapest deal, but somebody who's going to work with you when times get tougher.
Well said. There's a lot of people who realized what permanent capital was and wasn't back in March and April. Rebecca, what are your thoughts on debt and equity? I think you're primarily an equity investor, right?
Yeah, we're strictly equity investors, and I agree with absolutely what Charles says. It's all money is not green when it comes to debt, and you really need to understand who it is you're working with, and if things go wrong, and let's say a couple covenants are tripped, how are they going to work with you, going forward if things aren't so rosy, on the other end. I'm typically in other times in the market, more anti-debt. That debt is almost free at this point in time, it feels like, and so you're a little bit more warm and fuzzy to it. And a lot of my companies have taken on debt lines and things like that. But we pay really close attention to who it is, to the covenants, and so forth. And, having been a long time investor in fintech, I was at NextCard, back in the day, and, these warehouse lines can evaporate in the blink of an eye. And so when you look at people who are true balance sheet lenders, and if your business is a true balance sheet lending company, my encouragement is be very careful and really, really have long-term relationships with those debt providers, because those are really the first things that we see crumble when the market does turn.
Thank you. Maria?
The thing to remember is those debt providers have their own set of investors, right? That money is not just sitting there for free. So they're going to have to answer to other people. And typically when they're having to answer to those other people is when there is a financial crisis. And so they may have to take actions that have nothing to do with your company because of what's happening generally on their balance sheet. And so I think that's where we have seen the most conflict happen, is even if it's somebody that's well-meaning, you've got a good relationship, if there's a big financial crisis, that debt provider has their own set of issues that they have to deal with, which may force them to come to the table and act like debt holders, which is, at the end of the day, you're required, the goal is you're supposed to pay back that debt, and they have the ability to trump all the equity players, and they can use what looks like kind of a ridiculous thing, but it's a covenant. And if you have, even if it's minor and you have blown through the covenant, they have the legal right to force you to do things. And so I guess I would, pay attention to the covenants, right? Because even the ones that seem small can be used as a technicality to force you to do things that you don't want to do. And again, just remember, debt is debt. They have the right to do things, they have the right to force you to do things, and they have their own situation that they have to deal with, particularly in a crisis.
Well said.
Can I just add
Please.
To what Maria said, the debt providers have no fiduciary right or obligation to do what's the best thing for the business. They're, unlike investors, there is no obligation for them to act in the best interest of the company.
Right.
So I think some people would disagree with that, but yeah, that's one view. Maria, your point's well taken. When the securitization markets froze, the debt holders acted very differently earlier this year and last year. Brian, what are your thoughts on the debt and equity conversation here?
Yeah, I'd make two comments, one on venture debt and one maybe just a touch on the balance sheet lending piece. On the venture debt, I agree with everything that's been said. The one thing I would add, particularly what Maria was saying, is that I think a lot of entrepreneurs don't realize the person that sold you the debt and the person that you're dealing with day to day is not the person you're going to be dealing with if things go bad. And so I hear this a lot from portfolio goes, we have a great relationship with our lender. And I always ask, well, who is that great relationship with? And it's the salesperson that sold it to you and that's managing the relationship. What you should know as an entrepreneur is that if things go south, they wash their hands very quickly. They'll help you at the beginning, but then they wash their hands very quickly and everything goes back to credit and things go really bad to the workout group. And that person may take your calls, but is really not going to be involved nor have any power or say in the decision. As a matter of fact, they sold a deal now not working. So if anything, they could be a detriment to the workout. And so just make sure that if you think you have a great relationship with your lender, understand who exactly you have that relationship with. That's on the venture debt side. On the balance sheet lending side, this is really advice. We've done some balance sheet fintech businesses, one of the rare VCs that have done it multiple times. And I would encourage the entrepreneurs here that have a balance sheet business in its early stage to not over-optimize on terms, but to optimize for flexibility. Because investors like myself and the others on this panel understand that if you prove your model and your metrics, that over time you will be able to lower that cost of capital. We know who those players are, and we have an estimate or feel for where your cost of capital is likely to get to over time. And so I don't need to see that today in your unit economics. I want to know that you have a flexible partner that gives you the time and space to prove out your model from a balance sheet perspective, such that you can either grow with that partner and they can give you a lower cost of financing, or you can graduate to other partners that might have more flexibility. And then the last piece is just on the belts and suspenders around balance sheet capital. We encourage all of our balance sheet companies, make sure you're not, you don't have one master, right? If you have a warehouse line, have a backup. You have securitization partners, have many of them. And it's not easy to do that in the very early days, but as soon as you can, try to add more partners and more flexibility so that you can show the investors that you don't have a single point of failure in your business that could impact your valuation or really the potential to operate properly on a strategic level.
So that was great. We're almost halfway through. The next topic is really a softer topic, but perhaps as important as the others. We're going to stay with Brian, Maria, Rebecca, then Charles back up the ladder. Brian, you're first. Give us some thoughts about diversity, inclusion, and mental health, and one specific takeaway for our audience today on one of those topics, please.
Yeah, I mean, clearly diversity and inclusion is a very important topic. I think most, if not all, venture funds are very on today, as are a lot of our portfolio companies, if not all of them. There's a massive effort going underway to diversify the boards, diversify the senior teams, and make sure that the hiring practices and just the way the businesses are run are fair and equitable. And I think that's great. And we're starting to even put things in our term sheets to enforce that, going in and making sure we set our expectations. And so I think that's really important. On the mental health, I think that's in many ways been a bigger issue over the last 12 months, just with the pandemic. A lot of companies, I'm sure a lot of people that are listening to me right now, feel burnt out, feel like every day bleeds into the next. I know for myself, because I haven't had as many in-person meetings, I lose frame of reference on when I last spoke to somebody. Was that 1 month ago or 3 months ago? Because usually I can tie geography or a travel situation to it. And so, I'd encourage the leaders and the executives on this call to force vacations for your team. Make sure you're really giving them time and attention, and understand that they're humans, and a lot of people are dealing with issues, whether it's loss or other home. And it's probably one of my biggest concerns right now is that the market for tech has been hot. Everyone feels like they need to take advantage of the opportunity in front of them and work really hard. You can burn out and have a long-term problem. So not to have great advice around this, but really encourage people to provide those resources. I think you should be talking to your chief people officers about putting benefits in place now, whether it be around wellness, around mental health, for your employees, because I think the next year or two, you're going to see a fair amount of burnout, and some people choose to sort of drop out just because they can't deal with it anymore. It's a real issue.
Well said. Maria, what are your thoughts here?
So on diversity and inclusion, I would just recommend do more than just make a statement. And one sort of piece of very practical advice is open the clubhouse. So as you think about, and what I mean by that is, think about the role that an internship can play, both at your firm, if you're a venture fund, or if you're at your company. Because there's nothing more valuable than kind of letting somebody inside to the inner circle, as it were, to work with you, develop a relationship, et cetera. And on the technology side, it sometimes can be a little bit more work, but I think worth it. There are a whole number of programs that have been started in the last couple of years that are training a population that's typically not been in technology for technology jobs. It's a little bit more work to seek those organizations out, but I'll give you the names of two of them that are in New York. One is Perscolis and one is Pursuit. And they are taking populations that are traditionally not tech, typically people of color, who've not, some cases not a college degree, and they're running them through a training program for often kind of the beginning level of technology at your firm. So I'd recommend to take the time to meet them, get to see what their graduates are doing, and actually hire them, either for permanent positions or in an internship. And then on the mental health side, as I think about sort of the CEOs, I think it's a good time to see if you can, since we're now opening up a little bit more, is some more one-on-ones with the CEOs and kind of getting beyond the business. Like, how are they doing? Maybe go for a walk in a sort of non-work setting, checking in with them. And, there's a little bit of the lonely at the top where they feel like they need to remain strong for their employees. So take on the role of trying to be supportive of the CEOs. And for you that are entrepreneurs, I think it's totally fair game to call up your lead VC and say, hey, can we just sit down? I want some ideas I want to run by you, or can we just take a walk in the park? And share with them. I think we're expecting to hear these sort of things from our entrepreneurs, and I think it's totally fair game to call people up and say, hey, let's sit down and have a chat.
Agree. Rebecca, what are your best practices here?
Yeah, I mean, maybe it's part of who I am or being female. I don't know, but I always have been pretty tuned into the CEOs and try to spend time with their employees. And even at our partnership meetings, I'll be like, "Hey, I think so and so. He doesn't look the same to me, he or she, and maybe we should have some time." And I always will make a point, and I think it's so important, especially now, to understand that person a little bit more as a person, and not just how the company's performing, but what's going on in their personal life, and encourage them to take time. And I had an old engineering professor that I adored, and his thing was, he would always tell us, and hopefully this is better than the pineapple quote, Ron, but he would always say, take time to sharpen the blade. You're not going to get anywhere hacking through things with a dull axe, right? And so it's actually worth it to take the time out, sharpen the blade, and then come back. And I'm always encouraging people to do that and just take time out for themselves and for some reflection to come back, renewed. And we just see, I've seen CEOs time and time again, when they take that break, they come back and they're like, wow, I've rethought this whole thing, right? And if we really want to get big and grow faster, we actually need to make a few hard decisions or changes. And so even in normal times, we've seen that really help a lot. And so I think now more than ever, we need to encourage people to really take that time for themselves, sharpen the blade, and really figure out the best way forward.
Well said. Charles, what's your takeaway for the entrepreneurs listening to us about diversity, inclusion, and mental health?
Yeah, some unbelievable responses from the panel already. So just maybe to put a point on it, you can't wait. You have to do this from the very beginning. So I see my companies that are shining lights for the rest of our portfolio on diversity and inclusion and work-life balance. They don't wait until they're 100 employees or 200. They were doing it from the beginning. They're proud of the diversity mix at 12 people. They make a point of waiting the extra 2 or 3 months to hire that first general counsel to make sure there's diverse candidates in the mix instead of just jumping at the first one. So, all of that is just a very tactical suggestion to highlight what Brian and Rebecca and Maria all said. I mean, you just have to do it from the beginning if you're starting a company. And if you've waited, it gets harder and harder. And for those folks, I think, to the earlier comment, you have to walk the walk. You can't just talk about it anymore. And if it means slowing down a key executive search or doing something hard, it's time to do it.
Great. Let's stay with you.
I just want to add one last resource just on the DEI stuff. We hired a firm called Collective DEI here in New York, just for those of you looking for another name, that held DEI training for a number of the executives in our portfolio. We kind of left it open for anyone to join. And then we've had a couple of our portfolio companies like Better Cloud work with them directly. I know Bessemer's investor in Toast who's used the same firm effectively. So just another name for those out there that are searching for a partner in training.
Very helpful, Todd. I would encourage the LendIt team to publish some of those names. Super valuable resource for everyone listening here today. Charles, let's stay with you and let's go to the topic of secondaries. We see Forge and EquityZen and MicroVentures and CartaX and then all of these secondary funds out there calling up people that work at your portfolio companies or your portfolio companies looking to buy secondary shares at some discount, preference, and common. Charles, lead off this topic of secondaries and discounts. How do you feel, see, and think about it these days?
Well, it's become very commonplace, and that's been a real change over the last, I'd say, even 2 or 3 years. 7 or 8 years ago, it was quite rare when I got onto the venture side. I think it really started about a decade ago being a thing for the hottest companies that had already achieved some success. But the proliferation is pretty severe at this point. First of all, it's a fantastic thing for entrepreneurs and founders, and it's going to foster, even more creativity because people are feeling like there's a lot of value in early stage equity now because there has been liquidity thanks to all the money that has flooded into the asset class. I, as a board member, frankly, I went through this a little bit as an employee. I was an employee at Foursquare When we were 10 people, we went to 200 people. There was some secondaries early on. Not everyone got a chance to participate in it, and it changes the culture for a period of time. It's a huge distraction. So as a board member, I don't want to begrudge people the opportunity to diversify out of the one company that they're building. Life-changing money is amazing for people and their families. But I try and work with the team to talk about the implications of selling secondary. It goes beyond just the economics of it, and try and make it a controlled process, not to have it be this constant distraction. And most common these days, your existing investors are going to be happy to buy that secondary. So it's better to do it in a controlled fashion, whether it be at a 0% discount or 20 or 25% discount, which was more common 2 or 3 years ago. I would say it's important for entrepreneurs to lead by example, perhaps limit the amount of their holdings they're selling and make that same percentage available to the other members of the team, and not have it be this constant thing that keeps coming up. And I think it's okay to put some restrictions in the documents, so it's hard for these new liquidity providers to have that distraction be there for the first 5 to 10 years of a company's life. So I think it's okay, but it should be controlled. That's my take.
Thank you. Rebecca, what are your thoughts on secondary transactions?
Yeah, I don't think I have anything much beyond that. I think, having it controlled is the right way to do it, just to minimize distraction and have a reasonable process. And I think we're going through it with one company now where they've had inbound offers to acquire. There's also a really interesting path for them to be a multi-billion-dollar company in front of them. But, for the founders, it's life-changing money. And so to make sure that our incentives are aligned with the founders, we're open to letting them take that money off the table, pay off their mortgage, and then feel confident that they can go, forward and really, play for higher stakes. I think that's a very fair and equitable way to approach it. And it's really, as an investor, it's just the right thing to do. And then it's how do you run the process and trying to make it as controlled and as efficient as you can is really the way to do it, as Charles said.
Thank you. Maria?
So although the concept of these secondary sales is new within early stage venture, it's been around for public companies as a concept a long time. And I guess the thing too, and I'm sure I would guess the venture world is going to get there, but where things are in the public markets is what management is selling of the shares that they own in the company they're running is a really important signal, to the point where you have to disclose it above a certain level. And so just I guess my advice to entrepreneurs is recognize that you're selling any shares in the company that you're running, particularly at the early stages, is a signal. And so you don't have the same disclosure requirements as you do as if you're a publicly traded company, but making sure that you are, in effect, kind of handling the disclosure well, which is making sure your VCs understand. There's a lot of transparency around it, but recognize that your actions there are a signal to your investors, to your employees, and to future investors.
Great. Brian?
Yeah, I think everyone pretty well covered it, so I'm not sure I have much to add, but I guess the one thing I would say, just to round it out, is I think everyone said it well, but it's really about the level of the secondary. If you end up having certain employees that are pulling millions of dollars in the secondary, one issue that can pop up is that their boss, right, that comes in later, and if you have the liquidity at the early stage, their boss could be making $150,000 to $200,000 a year, and their direct report has $5, $6, $7 million in the bank. It creates a really interesting dynamic. It makes it hard to run a company. And while I was talking, what popped into my head was really a post-IPO story. I remember when Google had just gone public, one of the top executives there, I know pretty well, said that was like a major issue post-IPO at Google, is that they had to bring in a layer of management, and all the junior people were worth many multiples of the senior people, and it created a very strange dynamic internally that they had to work through. And I'm not saying that's a common problem in early stage, but if early stage secondary continues the way it is and the dollars get big, you could see that strangeness and that weirdness leak into your organization.
Great. So we have 2 minutes and 40 seconds left. And this last topic is one I know we're not going to get all the way through. I'm going to throw a jump ball out there, whoever wants to take it first, second, or third, or fourth. And that's the answer of capital structure. Most employees and many investors actually don't understand common, preference, the stack, and the waterfall. So I'm going to throw a jump ball out there. Charles, Rebecca, Maria, or Brian, who wants to take 1 minute of our 2 minutes left and take the first shot of just explaining at a high level how this all works?
It's a pot of money, and the question is who gets the money out first. Very simple. So if the higher you up as a preference, the higher the letter, I guess it's the higher letter, you have the rights to the money first. It's very simple.
Maybe just to chime in, I think this comes back to market conditions, but right now a lot of people are not distinguishing between preferred and common shares in terms of value and the meaning of these preference stacks. But many of us have lived through the meaning of these preference stacks, and preferences are valuable. So when common shares are being bought at no discount in these secondaries, people are forgetting that value or not forgetting, and they're willing to take that risk in the event of a downside scenario. So it's important to keep your preference stack in mind when you're building a company, because as an entrepreneur, you're putting your sweat, and your team is building something real. And the lower that preference stack is, the better off you'll be at exit.
Anybody else?
Yeah, I mean, the only other piece to touch on is just there's the preference stack, and then there's just the rights, the governance-oriented rights that come with being a stockholder that really, I think, are the key areas. So for all entrepreneurs that are less knowledgeable about this, hard to do it in 30 seconds, but I'd encourage you to get a really good venture lawyer, an experienced venture lawyer. If you don't have one, your lawyer is somebody that doesn't do venture-backed deals for a long time. Please fire them right after this session and go get a good lawyer, and that'll and have them educate you, and that's the best thing you could possibly do.
Great. Well, with 20 seconds to go, I want to thank all of our panelists. This was very candid and informative. And thank you, Todd, Peter, Bo, and the whole LendIt team. For me, I've been doing this in fintech and venture since 2008, and I've never been more excited to be part of this industry. So thank you, everyone, for your participation today.
Thank you.
Thanks, Ron.
Thanks, Ron.
Thanks, Ron.
And thank you, panel, for joining us. And thank you to the audience.